Markets have been rallying today. One factor pushing markets higher said to be signs of easing tension between Israel and Iran. Our guest, though, says it's time to be more cautious in stocks at current elevated levels. He does see downside risk. Our guest sees downside risk. Let's bring in Sameer Samana, Senior Global Market Strategist, Wells Fargo Investment Institute. Sameer, thanks very much for coming on the show. You still think markets look toppy?
We do. I mean, last week was just, an amuse-bouche, if you will, in terms of what could happen if some of these things really do go kind of sideways. We don't think that inflation comes down easily. We think the Fed probably is forced to be more restrictive than markets anticipate. Earnings, as you've already noticed with a couple of companies, the bar is incredibly high. We don't know if the broader index can really mount kind of the high level of those expectations. So I think for all those different reasons, we could stay range bound until the elections in the fall.
That's interesting. And of course, there's probably going to be volatility around the elections. Why do you think investors have taken it in that we could get very few interest rate cuts in the U.S. this year, maybe even none?
Yeah, I mean, if you look at what services inflation is doing, if you look at what energy and fuel prices are starting to do, and geopolitics is only accelerating that upward move, if you look to see that wages are still kind of sticky and high, if you look to see that rents are still sticky and high, it's just very difficult to see where the disinflation comes from. I mean, goods, which was probably the lone bright spot, even that suggests that those prices are starting to bottom out, may start to tick back up as the year goes on.
So you think inflation it's the beast that's almost impossible to kill right now?
Yeah, the analogy we've been using is it's the straw that stirs the drink. And unfortunately, you've got to solve inflation before you can kind of, from a sequencing standpoint, get those rate cuts and get the economic recovery that the market is hoping for.
And you reckon we're still seeing outperformance by the giant stocks? The poor old small caps are left in the shadows?
Yeah, I mean, we prefer to go up in market cap. We prefer to go up in quality. Right now, U.S. large caps are kind of in the first tier. I would put U.S. mid caps and developed markets outside the U.S. kind of at the tier 2, and then really kind of bringing up the rear would be small caps in the U.S. and then emerging markets. We still think it's much too early for those cyclical areas, which are very sensitive to those economic tailwinds.
What about healthcare, classic defensive? Do you think that's a good area in the States right now?
We like it, but we would pair it. We'd pair it with industrials, energy, and materials. We kind of liked the reflation trade when we started the year. Now, unfortunately, that camp is a lot more crowded, so that doesn't make me feel all that great. But healthcare has been one of our picks that people haven't gravitated to. And we think that there's some really good valuations. We think that there's some really good underlying earnings growth there. And so from a timeliness standpoint, it's probably the most timely of our 4 picks.
When you say healthcare, do you mean the more conservative end, such as the health insurers?
Yeah, I mean, health insurers, some of the higher quality, larger cap pharmaceutical companies, we would stay away from, kind of those cash burning, smaller cap biotechs.
Just remind us, if you would, you touched on the election. What about the pattern in U.S. presidential election years? Do they tend to be good stocks? Is there any clear evidence? Good for stocks?
Yeah, the first part of the year is not bad, just because you've got the incumbent party trying to, kind of make the economy look as good as possible. But the tricky part is there's just so much uncertainty, especially if it's going to be a close call as to who wins the election, that you just have kind of the market in this suspended animation. And it's not really until after the elections that the market is kind of, untethered from all that uncertainty. And I would also say that, look, it has nothing to do with politics. The market will figure out a way to go up with either party. I think what will change is what sectors and what areas will do well, depending on who wins in the fall.
You talked about inflation. You notice how entrenched it is. And you do see signs, though, of weakness in the economy. Small biz optimism, you say, is still in a 2-year downtrend?
Yeah, I mean, that's the tricky part, right? Is we all know how slowdowns kind of start out, right? They always start out kind of in the bottom tiers of whether it's smaller businesses, whether it's less, well-off consumers, whether it's, kind of shakier, businesses with shakier finances. And that's what you're seeing right now is all those fragile, kind of, fringe, consumers and companies are already starting to face a lot of issues. You're starting to see a lot of default rates start to kind of tick up. And we think that will continue until you take in a greater and greater share of consumers and companies, that kind of find themselves, in some distress as the economy starts to kind of soften a little bit.
What about bonds? Would you recommend people go load up on, say, 10-year U.S. government bonds right now?
It's probably a little early to load up on duration, but we do like it. I mean, if you think about where we started the year, I believe on the 10-year we were closer to 360, 370. So you've moved up almost 100 basis points. And when you think about where rates have been over the past decade or so, we're well off those lows. So we think for investors who are kind of looking over a longer horizon, locking in some of these yields in kind of the mid to high fours on the longer end does make some sense, because while those yields on the shorter end are higher, the tricky part is once the Fed starts to cut, they may cut quickly and you may not have time to lock those in.
Yeah, that's interesting. What is your, I know it's almost like picking a horse in a horse race, but how many cuts do you think the Fed will give us this year? Or do you think Jay Powell will just hold off and make no cuts?
We think right now a couple of cuts, but I guess if I would say where the risks are to our outlook, it's probably to the upside unless something goes, again, pear-shaped economically. I would say it's 2 cuts, but possibly less if the economy continues on its recent resilient streak.